to today's webinar entitled Energy Pathway to Maximize IRA Tax Credit Monetization for Colleges and Universities. My name is Billy Zydick, Manager Special Programs for APA. Just a couple of housekeeping items before we get started. The webinar recording will be posted to the APA webpage under the Continuous Learning tab later today. Professional continuing education certificates are being offered for today's program. Those who indicated they wanted a certificate at registration and meet the requirements will receive certificates later this afternoon. All attendees are in listen-only mode. Please type your questions in the chat box and they will be answered in the order they are received. If we run out of time and we still have questions, responses will be sent directly to the person asking the question by one of our presenters. Before we get started, I'd like to take a little time to introduce our speakers today. Abigail specializes in sustainability and energy efficiency in higher education. She combines her environmental background and fresh perspective with valuable industry experience to help colleges and universities conceptualize, design, contract, and implement comprehensive energy infrastructure projects. She works closely with both financial and facilities departments to understand and help create solutions that meet the unique energy needs for each institution. Regina brings over 20 years of experience helping businesses, not-for-profits, and public sector customers transition to a low-carbon world through integrated solutions coupled with creative financing. Over her career, Regina has led teams to win and develop over $500 million in comprehensive energy efficiency and renewable energy projects for a variety of customers, including colleges, federal institutions, housing authorities, and commercial entities. In her current role as Vice President of Sales for North America, she is responsible to set the strategy and deliver on the company's goals to be a leading provider of comprehensive solutions that help our customers and communities to meaningfully reduce their carbon footprint as we all strive to meet the challenges and pressures of addressing climate change and the need for resiliency in our buildings and grid. At this time, it's my pleasure to turn this over to Abigail and Regina, our speakers for today. Ladies, take it away.
Hello, everybody. It's an absolute pleasure to be here and talk about today's topic, which is the the Inflation Reduction Act and how higher education can now utilize these incentives and provisions under this legislation. So my name is Abigail Gertis, as Billy mentioned. I am an account executive at Centrica Business Solutions, focused in higher education. Joined with me today, I have Regina Durga, which I'll let her introduce herself.
Billy, hi, thanks so much for having us today. Billy's did my full bio, so I think that's good enough, and I'm going to turn it back to Abby to get us going.
Sounds good. Now, I'm just going to bear with me for about 30 seconds. I'm just going to explain, who Centrica Business Solutions is and why we are, why we are qualified to talk about this topic today. So Centrica Business Solutions is a turnkey energy services company. So as Billy mentioned, we design, we help plan, we implement, we help contract energy efficiency projects. We have done over 130 schools, higher education facilities across the U.S. And ever since August of 2022, we have really spent a lot of time researching and understanding the Inflation Reduction Act because it's very prevalent to our industry. All right. So a couple of the topics we're going to talk about today. So we are going to talk about, kind of the common barriers and challenges that we are seeing currently in higher education and some of the current solutions to those challenges. We're going to talk about utility rate increases and how that affects project feasibility. And then we're going to get into, the bulk of this topic, which is the Inflation Reduction Act. And then we're going to conceptualize a, like a sample project to see how this all culminates together. All right, so a lot of the schools that we have talked to, they're really struggling to implement their sustainability goals or to tackle their deferred maintenance. Typically, we see that this is due to either competing budgets or, concerns for the enrollment cliff. And a lot of the times these schools are kind of piecemealing projects. So, you know, they're replacing equipment whenever it's past its end of its life, or they're replacing it because it's broken down, or they're just doing smaller projects that really tackle low-hanging fruit, which we find that this is not as effective for schools to do to keep up with their infrastructure or to attain their sustainability goals. So some recent development for project improvement or project improvement. So, you know, as I mentioned prior, you know, utility rates have increased, right? We probably all see this. We see this within our budgets and things like that. But increases in utility rates can actually help project feasibility. You know, the more you're spending on your utility bill and then you implement an energy infrastructure or an energy efficiency project, you're going to generate more savings, right? And then, you know, in culmination with that, we have the Inflation Reduction Act, right? So there's now tax credits and incentives available from the federal government for clean energy projects. And then local incentives as well. A lot of states, you know, across the US have local incentives for energy efficiency or renewables, and these can be combined with the Inflation Reduction Act. All right, so now we really just wanted to drive home the point about, you know, utility rate increases. So we've seen, you know, we can, as you see in this graph, there's been about we looked at 20 years. So we've seen an increase in utility rates. More specifically, we've seen a spike from 2021 to 2023 of utility rates. So, you know, the purpose of this was to really just showcase like what we are analyzing within utility rates and how this can, and then later on we'll talk about how this can affect project feasibility and what this means for projects. All right, so now I'm actually going to pass it off to Regina, our subject matter expert, regarding the Inflation Reduction Act and its provisions.
Thanks, Abby. You have the slide. You still have, okay, thank you. All right. Sorry, I had to step away for a second. My dog is always on the wrong side of the door. So this is the challenge of working remote. So first thing I'm going to do here is level set. So I don't want to assume that everyone knows what everything is: investment tax credit, production tax credit, 179D. So the investment tax credit is an actual credit for doing a renewable energy project. And it's paid off. It's a percentage of the project cost for that project itself. The production tax credit is actually, it's typically used for wind in the past, and it is actually a per kilowatt credit for the amount of energy that's produced off the system. So in the past, the investment tax credit, what we saw was actually declining over time. So for example, from last year to this year, we've been from 26% to 22%. So we were seeing a declining block on that, and the production tax credit was really reserved for wind, and again was reducing over time. And then also 179D is a tax deduction that is for energy efficiency. So that would be for, it was very specific to the measures that were installed, and was paid as a deduction on your taxes that you could take advantage of if you were a tax-paying entity. So the other thing in the past was the investment tax credit and production tax credit is for taxes. So you had to be a tax-paying entity in order to get it. So typically, if you have done a project on your campus for solar, it was really geared towards solar and solar plus battery storage if they were tied together. And if you've done a project like that on your campus, you probably have done it through a power purchase agreement. So you worked with a third-party provider to install that system. They own and operate that system on your property, and then you buy the energy at a preset rate, a power purchase rate, over the term of the contract, which was usually between 20 and 25 years. So that's the way that we've seen it done most often on either public institutions or for either public institutions or for private nonprofits. You have no ability to take it yourself, so in order to be able to take advantage of that credit, you really had to work with a third party to do it for you. Now, one of the key things that has changed, there's two things that have changed that directly impact the things I just talked about. One is the amount available over time has been stabilized. So I just mentioned that it was a declining block, makes it very challenging for investors to know how, and there was a constant race to get the project in. Because, oh my gosh, the ITC is going down, 6% by next year or whatever. So there was this constant cliff that was in front of people, and then Congress would change it. Same thing with 179D, it would have to get renewed every couple of years. So there was a lot of influx or flex, and it was hard to plan for it. So under the new IRA, that is stabilized over the next 10 years. Now, provisions become more stringent over time. So that is good to know. So there's still that kind of compelling reason to move on projects earlier, just because it does become more stringent to qualify for certain things over time. But there is stability in it. And then also 179D has been stabilized and the rules are more clear. So now the other thing that has changed that is really important, sorry when you say it's fine. The other thing that's changed that is really important is direct pay, and that's what's called out here. So you, as a non-tax-paying entity, either public sector or a private nonprofit, are actually able to take it as a direct credit now. So like I said before, you'd have to use a third party to get it, but now you can include it in a project and take it as a direct project buy down. Okay, next slide. All right, the other thing is there's expanded qualifying technologies. So you can either get the ITC or the PTC, and there's other technologies that are available that could qualify. Now, key thing here is we're going to focus on the ITC, because what we've looked at in the analysis that we've done is that the PTC really, you need to be above really about 10 megawatts. You need to go in above. So the more utility scale you go, that could be a better way of looking at it. But for the projects that we're typically looking at for campuses like yours, we're probably going to be looking at the ITC. Okay. So now let's talk about how you're stacking the value of it. So the base rate, that 6% at the bottom, you qualify for no matter what else you do. So you do a renewable project that qualifies for the ITC, and you're going to qualify for that 6% base. But then the next level up, the next stack above that, the 24%, that's for you is the biggest stack, and that's for doing prevailing wage and apprenticeship. So the Inflation Reduction Act is really it's not just a renewable energy, I mean, there's a lot of stuff in there around other provisions as well. But what the administration was trying to do is build out from up from the bottom and out from the middle. So prevailing wage and apprenticeship is required for all of this if you want to get a meaningful credit for your project. So if you're a public sector customer, prevailing wage is common hat for you. You're doing it on everything anyway. And then apprenticeship is just something that needs to make sure that we're taking a look at, and we make sure that we qualify for on every project, so that we're getting that base amount of 30%. Now, every adder above that, the 10% on the domestic content, energy community, or low-income community bonus, every additional 10% adder has certain requirements around it. So for every project we want to look at, or you want to look at, okay, we're going to qualify for the base amount. We're going to assume prevailing wage and apprenticeship because that's the minimum. And then how do we? Is it possible, or can we value stack these other ones on top? A lot for both the energy community and the low-income piece. That is really about location, and more than anything else. Okay, so same idea for 179D. Again, this is a tax deduction, not a tax credit. You are not able to take this as a public institution or a private nonprofit. So this would have to be a transfer credit, which is the way we look at it in our analysis. So you actually need to be the engineer record or that kind of role in order to take advantage of this. And there are very specific rules, but again, it works the same way. You have a base rate, prevailing wage and apprenticeship needs to be met in order to get a meaningful amount. We looked at the 25% is that once you get there, you get that $250 a square foot. You actually have to go a certain percentage, a 25% increase above ASHRAE standards from 4 years ago in that building, and it goes up incrementally. So we did 2 jumps on the slide, so you can see, the 25% increase, and then the maximum at the 50% increase. There's actually a little bit of an incremental increase at each increase in efficiency. It brings up another 2-cent credit or 2-cent deduction per square foot. So there's a scale in there that you just don't see on the slide. We also talk about local incentives. So this comes right off the Desire website. Many of you may be familiar with it. If you're not, it's a great site to go to see what's available in your state. We're seeing more incentives towards electrification, which we actually reflect in our model. But in general, if you look at this slide, the slide tells you that if the state is darker, there's more programs available. Again, as you're looking at every project, we're trying to value stack all of the incentives that are available and count those in and take it off your project cost. So typically this is like the best world scenario. This is what we would love to see. We come in and we plan the project. We're going to cut as much as we can by doing efficiency and getting that to getting your energy usage low as possible before we overlay, you know, your renewables on it, so that we're not oversizing those assets. Even with incentives, they're so expensive, so we want to right size them. So this is like the best world scenario where then we can, you know, layer on demand response to bring additional revenues in. But you know, we often see out in the real world, this is not actually how things get deployed. Like Abby mentioned earlier, you're kind of doing these onesie twosie projects. So we'd love to hear from you on where you are in your journey. Is there a poll in here? I think we missed a poll.
We did. My apologies.
So this would be the second poll. This is just to make sure you're, you know, keep everyone engaged. Otherwise, we just talk, you know, we're talking. I'm not sure, Billy. Is there a poll?
Bear with me. It's giving me a fit at the moment, so I apologize.
If we don't have a poll, we don't have a poll. It's okay.
I'm glad we're all having, you know, a little bit of technical issues here.
Yeah. I mean,
it's not letting me bring up the polls. I apologize.
That's all right. This poll was going to be fantastic. It was amazing. It's okay. No, really what we're trying to do is keep you engaged, but we see it out there all the time. A little bit.
I got it. Hold on.
Okay. Okay, this is the first one. So we'd love to hear from you too. What challenges are you guys facing out there?
Okay, I'm going to close the poll.
Okay, yeah, budget is a big one. We're going to pull in, show another way to get it done. That's always huge. All right, do you want to do the second poll too? We can just do it all at once.
Sounds good.
Thanks. Budget is always huge, and then prioritizing other projects. I see that, you know, having the resources to get these kind of projects done is always challenging.
Okay, I'm going to close the poll.
Okay. Yeah, that's interesting. I think that, you know, 49% implemented efficiency measures, that's not uncommon. And then it's still 63% in planning. So it's probably, like I said, a little bit all over the place, right? Like we see that too. Like you've got a little bit here and a little bit there, and then how do you really pull it all together? All right, so, okay, so I'm gonna actually turn it back to Abby. Yeah.
Yeah, hello again. So, you know, what does this mean? What does this look like whenever it's actually implemented into a project? So we actually took a like sample scenario to conceptualize this. So we just kind of, you know, we created basically a school with 3,000 students and 2.2 million square feet. And then we wanted to make this scenario really kind of realistic. And we chose a scope of work that is kind of a comprehensive project that would tackle, you know, a little bit of efficiency and some sustainability for you, which included some LED lighting, a solar, you know, some HVAC electrification and other efficiency measures. So what would this scope of work qualify under the, you know, the ITC and the IRA? So we actually took kind of a conservative approach. So, you know, for the ITC, for the solar component of the scope of work, it would qualify, we decided it would qualify for 30%. So you get that base rate, as Regina mentioned, at 6% for basically doing nothing, right? For just having a solar component of this. And then we included prevailing wage. So that brought you to a 30% ITC. And then 179D would qualify under the efficiency measures that were within the scope of work. So again, we took that base rate. Since we're already utilizing prevailing wage for, to obtain that 30% ITC, that was already included in there. And then we chose about a 25% increase in efficiency because we've seen that that's pretty standard across all projects. We can achieve a 25% increase in efficiency. So we're looking at about a 30% ITC and then about $2.50 per square foot in available credits and incentives. So in order to really understand kind of the project financials of this, we needed to understand, what the utility rates were. And so we created a scenario where we compared the same scope of work from 2020 to 2023. So we took the national averages, the national utility averages from a couple of slides prior. So for 2020, we used 14 cents a kilowatt hour. And then we actually took a real school and their consumption that had roughly the same size school that we're modeling here. And then we calculated the expense. So, for 2020, we're looking at 14 cents kilowatt hour, and then for 2023, about 17 cents per kilowatt hour. For natural gas, we also took those national averages as well. So $1.07 a therm for 2020, and then $1.82 a therm for 2023. This is really going to relay in a couple of slides as to how this affected the project financials in combination with the Inflation Reduction Act. All right, so what would these measures, what would the ITC and the 179D, what is that value of them with these measures? So in 2020, as Regina already mentioned, the 179D was available. However, it's now under the Inflation Reduction Act stabilized. So in 2020, we were looking at roughly, $380,000 for a transfer credit under the 179D, and then no ITC because that wasn't available for nonprofits via direct pay. And then in 2023, we see about $1.8 million basically for the ITC. So that's that 30%, tax credit that you guys are direct pay that you guys are now applicable for. And then in 179D, we kind of see that number jump up to about $500,000. All right, so now we're going to get into the project financials, and I'm actually going to pass this off to Regina to really go through these line items.
Okay, so this is the fun part. So in 2020, this project that we identified across this campus, a comprehensive project, would be about $17 million. Right, so we're assuming that we're touching a good percentage of your square footage, and we're getting, and we're getting a comprehensive project. So in 2023, you'll notice that actually increases. So we took and adjusted it for inflation. So we've all felt a lot of inflation. I know that we felt it in our own budgets, but all our projects are costing more than they did 3 years ago. And so we wanted to adjust it and make it a little more real. The utility incentives in 2020, we saw about $650,000 is what we calculated for the measures that we were installing. As we said, they've been increasing with electrification. This sample project includes a lot of electrification, so that increased as well. Now, that is very state specific. We actually based it on, I'm sorry, my dog's back there. We actually based it on what we see in Massachusetts often, and discounted it for a national average because Massachusetts is very aggressive in this, and it would have been twice as much as if we kept it in Massachusetts. So we discounted it back to give it more of a national average, but it is a trend that we're seeing, so we did want to calculate that. Then the tax incentive total. So it's at the bottom, but under 2020, we saw $376,200 on a direct transfer and a transfer credit for the 179D. Now you may see like this, if you look back and you remember the slide before, there's over 2.5 million square feet of campus. That doesn't seem like a lot. Well, there's a couple things that we again want to be conservative, And we took into consideration, one, did we reach 25% increase in efficiency in every one of your buildings? So we cut the square footage in half. And the second thing that's really important is this is a transfer credit, which means you need an off-taker with a tax appetite. It's going to be, their tax rate affects the amount that they're actually qualified for, that is valuable to them. And they're probably going to hedge for risk. So we take it, we discounted it for all those factors. One of the things I also want to say about this, it is harder to get it because you can't take it directly. So, but I want you to be aware of it as an institution, to ask your designers or ask, hey, is this applicable for my project? And is it meaningful? So it's really to make you aware of it. And like I said, we discounted it to try to make it realistic, but there is a challenge, and it's not the easiest to get. So the other thing I want to, so their net charge, so the same thing on the right-hand side, so your tax incentive total, you're at over 2.1 million. So if you look at the bottom, what makes that up? 1.6 million in ITC direct pay available to you this year, and 522 increased transfer credit. Again, we discounted the exact same way I mentioned before. So now, what is, and now the other thing you may notice if you have a good memory is in a previous slide that the ITC was actually much higher at about 1.8 million. So why is it only at 1.6? And the reason is because we're assuming that we're financing. And because you're either a public institution or a tax-exempt nonprofit, we're assuming a tax, like either a bond rate, a tax-exempt bond placement, or a tax-exempt lease purchase kind of structure. Anytime you take advantage of tax-exempt money to fund the project, you have to take a haircut on the percentage available under the ITC. So if it was 30%, it's a 15% haircut off that 30%, so you're only eligible for 25.5%. So that haircut is taken into account under this scenario. So net project investment, you see it's 16 million over on the left-hand side, it's 15 million on the right-hand side. So already you're with the increased utility, higher project costs, but the other incentives going higher, it still reduces your total project investment. Now, the other big thing, if you look at the energy saved on the left-hand side, you're at 1.14 million, 1.15 essentially million, and the savings produced off this project in your first year, just your first year savings. In the right-hand side, it's 1.8 million approximately, and that is as a result of what those energy rate increases are. Those savings are worth a lot more in 2023 than they were in 2020, and that's reflected in this as well. So what does that mean? You have a simple payback in 2020 of 14 years for this project. For the exact same project in 2023, you're at 8.3. That's an amazing difference. So then if you were to finance this project, which is often like, budget being an issue, that was one of the things that we heard that came back. You have a 4.1% rate over on the left-hand side. And then I did want to account for inflation on the right-hand side, so we have 5% on the right. Now you may be looking at this saying, oh my God, I could get money so much cheaper than that. Or, oh, that'd be great, I wish I could get it that. It all depends, right? So I know that, if you're bonding, it may go less. There's just, it's all over the place, but we wanted to provide a scenario that we could do a comparison on. So what would a potential finance, so the best finance term I think we could possibly do on the left-hand side is 18 years, and that is with 3% escalation. On the right-hand side, that same project with 3% escalation is financing easily within 11 years. So if you look at that and you think about it, well, if you're a public institution and you're used to doing performance contracting, you really build into that project and you can actually do more, right? You can say, I can easily go out longer. I'm used to that. And I could build a bigger project that meets more of my needs, gets more deferred maintenance done, and you could do a lot more project. Or if you're a public, private nonprofit, it's like, wow, I could actually, that's really attainable, that we could do it this way. And now bringing that solar in really makes this project, it's really a combination, obviously, with the increase in utility rates, makes a huge difference in what will cash flow, what looks good to your leadership, but also that ITC and being able to take it as a direct pay within that project really does help. And bringing solar in, solar starts paying for other measures, or geothermal, or other, just the same idea that you can take those tax incentives and start doing more with it. So with that, let's see I think that All right, so then I really wanted to provide this, we talked about this, we highlighted this earlier, and getting you on that sustainability roadmap as well, right? So it's, a lot of you are in planning. This is also a student draw, right? The more and more students are looking at this and saying it matters to them. So, you have a baseline, your development roadmap, like you're saying this is what your carbon is before you do this project. Because we're doing electrification measures in this as well, there's a 31% reduction with cut when you're cutting, and we're cutting your usage. And then we're bringing solar in, like we're electrifying, so your electric use goes up a little bit. Overall, when you're doing, if we just did that, but now we're bringing solar in as well, and we're cutting another 17%. That gets you 50% of the way there towards your goals of sustainability. And that is a huge campus draw. So it's something you can really be proud of and talk about with your students. So with that, we wanted to, these will be available. Obviously, we have some links here for you to actually, if you have any, to read more about the Inflation Reduction Act. So we just want to provide some resources for you. And then I think the last slide is our contact information. We want to be able to answer questions for you. So are there questions in the chat?
Oh, yes, we have questions.
All right.
All right, our first question is, when working with institutions of higher education, who at the university typically does the paperwork for these tax credits, and should facility managers and consultants engage with them?
I'm going to say this question back just to make sure I got it. So what I just heard was that you want to, so if you're working, who's doing all the paperwork for the tax credits, and how is it the university or is it the company? Right.
Correct.
So typically we're doing all the paperwork. So a company like ours would actually work and do all the paperwork. Now, it doesn't mean there's no role for the university, but even on utility incentives, all that, it's like we as a company, we do all of the paperwork, and we submit it all. A lot of times it requires a signature from the university or from the college, but we'll take care of all that. Like, we want to make it as easy as possible.
Okay, thank you so much. Our next question is, so a very large heat pump project designed to stop burning gas is a go or no-go project?
A keystone project, so like renewable natural gas. So every project that the way that it gets more stringent. So if you're looking to get rid of all your natural gas, so either through geothermal or like renewable natural gas or some other way, then that would qualify. You need to, there's nuances in it, so I don't want to say 100% it would qualify, but the key is that the project is net zero. So like there's qualifying technologies. If you saw that one of them is like qualifying fuel cells. So after 2025, I believe, it needs to, I believe it's actually 2025, but I can, if you follow up with me, I'll get you more detail on it. That technology has to be net zero. So if you're just installing a fuel cell, for example, and it's running off natural gas, that doesn't qualify, though. If you had some sort of carbon sequestration with it, it would qualify.
Thanks, thank you. Our next question is, what is the baseline energy code for the 179D tax credit?
Oh my gosh, we knew we were going to get asked this. It's 4 years prior. Abby, do you remember what the actual code is? ASHRAE 2001 dash. Caitlin, can you look that up while we're talking? It's 4 years prior. So, but we have some people on the phone with us that can look it up as we continue on.
Okay, it's the same person answering the question. Are these modalities applicable for new constructions as well as renovations and upgrades?
Oh, for the 179D?
Yes.
Okay, so 179D is for renovation. All right, I actually need to get that answer for you. I want to be sure before I tell you, because it's one of those, I believe it's renovations, it's for the built environment, but the reason I'm hesitating is because if you went above code, current code, so the code for 179D in a built environment goes back 4 years prior, but if you went above code for current, what's your current code now and went to stretch code, I don't think it qualifies. I think it has to be within the built environment, but I want to get that answer for you. So is it Billy? I'll just make sure I get that question and I'll send it.
I will send you a report with the contact information.
Yeah,
and our next question is, go ahead, finish. I'm sorry.
No, I was like, if other people have that same question, is there a way to share it out with everyone, Billy?
Yes, I can post it to the website when we put the link of the video up as well.
Okay,
so
yeah, I
can
think
answer the questions.
I think that might be a common one for more than one person. So I just want to, but I don't want to answer it wrong and then I'd rather be very sure.
Not a problem. We can do that. Our next question is, how much data do you need to get these tax credits?
So in order to get the tax credits, it has to be a real project, right? So so if it's something that is in construction or doing now, then you need to be able to I'm just trying to think. It's basically, here's what all the project costs are, here's what's eligible, and submit. So there's some guidance that we're waiting for from the IRS, to be totally frank, from the Department of Treasury, to say here's exactly what you need to submit to us in order to get it through. So what companies like ours are doing is forging ahead and saying, hey, this is what we're doing, and then Department of Treasury, we're ready to submit. How do we do it? So there's going to be, like, our understanding of it to date is there's going to be a similar to what you'd have to put in for your own taxes. If you put solar on your roof and you're going to take that tax credit, there's going to be like a shadow filing for some of this, and if you're a public institution. So there's a lot of guidance that we're looking for, but again, I'm happy to look at, I'm sorry, I don't feel like I'm answering that 100% clearly. It's just really, here's what the project cost is, here's what it is, and here's what the project summary, and submit to the Department of Treasury. Here's the production.
Sounds good. And like I said, we can go ahead and our presenters will get these questions, and if they determine they need to answer it a little bit more, you will get a personal email from our presenters. So the other question we're getting is about the slides. So I want to let everybody know that the slides will be available tomorrow afternoon. So once you get the confirmation email, if you just email me at Billie, BILLIE @appa.org, I'll send you a copy of the slides.
And I want to be clear about something on that last question. The reason I'm not like, this is exactly how you do it, is because we are waiting for guidance. It's not like we don't know. It's just that this has been a moving target for, it's like the legislation came out and now the government's responding to it. So it is a little bit of like, okay, and we're just keeping on going, and we're building projects now.
Yeah, and I'd also just like to add, we'd be more than happy to keep an open line of communication with you guys. So as that information comes in and we discover that, we can relay that to you.
Wonderful. Yeah, and we can always put, an update on the website too, as you get announcements for all of this. So thank you so much for the extra work you're putting into this. So our next question is, do you have to apply for the incentive before the project is started?
My understanding is no. So it's not a apply for the incentive, let them know it's coming. In fact, we're working with a client now where they're actually building a geothermal system, and then they're actually in the process of doing that. And we're looking to how do we have to capture that tax incentive and bring it back into more project. So they're actually doing the geos totally separate from us, and we're working with them to say, hey, and they started before this, the IRA came into being. So now we're working with them to say, how do we help you capture this? Like, we can do that. So that's
wonderful. Thank you for that answer. Can you someone was asking about the slides again. How do you apply for direct pay? Is there a form that you complete?
So that's what I'm saying, is that we're waiting for guidance from the IRS, from the Department of Treasury on this, to say, here's exactly how you do it. So our understanding is there's going to be so particularly if you're a public institution, there's going to be a shadow filing like that you would do, because most public institutions actually don't file taxes. If you're a private nonprofit, you're putting together your, again, you're not paying taxes, right? So there's going to be a shadow way to do it. We have been asking, everyone's asking Department of Treasury to come out with clear, like, here is the form. And I'm yet to see the form, but once we do, we'll post it.
Okay. I'm thinking, and I have one more quick question here for you. Can a project qualify for both the ITC and the PTC?
No, it is one or the other. And so, as I said, there's a the PTC is really much better for utility scale. So we focus on the ITC because that's typically what a college campus is going to be able to accomplish.
Okay, thank you.
I'm sorry. The other thing I'd like to mention that I think is really, really a neat thing, that the battery storage and solar is now decoupled. So before the new IRA, really, in order to get a tax credit for any kind of battery storage project, you would need to have it tied and charged from solar. So it would have to get charged from solar in order to really qualify for the tax credits. Then that is now decoupled. So battery storage qualifies for the tax incentive without being coupled with solar. And then I also have an answer for the 179D. So the IRS has affirmed that ASHRAE 90.1-2019 is the reference standard.
Okay, thank you. The next question is, can tax credits be applied when updating equipment, such as solar panels at the end of their life cycle? Are there any cradle-to-cradle plans required for taxable sustainability initiatives?
So cradle to cradle, you mean cradle to grave. So like, do you need to have recycling involved, right, in order to qualify? That is not part of it. So there's no requirements for recycling at the end or anything in order to qualify for the tax incentives. And the other question about upgrading, I have not seen any reference to saying, hey, like we have, unless you're going to do a full sale, I would apply. So if you're doing a full sale replacement of panels, or but if you're just upgrading an inverter, no, that's not going to qualify. If you're like, hey, this is end of life, we're recycling panels, and then we're going to, or reuse. If it was a substantial rebuild, then I think it would be worth applying for.
Okay. Another question regarding 179D, can you get a base rate of 179-D without creating an energy model?
That's hard. So you need to have a third-party verifier no matter what you do. So there are firms out there that, like, even if it's us taking the tax deduction as the installer of record, right, and engineer of record, there is that you have to have a third party come in and verify it anyway. So really that's what I would rely on a third party to do. And there's more than one firm out there that does that. We work with one fairly regularly that you can just submit everything, and then they'll do a pre-qual on it and figure out what the cost is to actually get you through the entire process. So they'll do a pre-qual to say, is it worth it? Are we going to get enough is the juice worth the squeeze? And then put a price to actually getting it done. So if you're a private client, then that's really, we'll actually just work with them and put it into that way. For public, again, you have to find your off-takers. It's a more challenging thing to get. I'd love to know if people are out there getting it now.
Okay. Our next question is there any way to get energy efficiency funding except for the 179-D?
Utility incentives is the most common and popular way, like obviously, and it's state by state. Not every state has great, we're working in, Ohio, for example. Ohio does not have utility incentives that are very good. There are other programs that come down, other grant programs that come down. We've seen it through like New York and NYSERDA, or but they're not on a federal level. So you have to, it's very state specific to, again, that desire map where you can say, hey, this is what's coming down. We try and stay in front of it where it was like ARPA funding in certain areas or other things. It's a little bit more challenging on that. It's not a federal program, I'd say.
Okay, our next question is, does 179-D apply to large greenhouses used for learning at community colleges?
Potentially, if you're going to reduce it, I'm wondering what the ASHRAE standard is for a greenhouse. So but if you're going to set up the, whatever the baseline was, and then you're going to reduce it by over 25% of energy usage, and do that, I don't see why it wouldn't.
Our next question is, can you use this for smaller projects, such as changing the buildings to LED?
Yeah, so we do that a lot too. So we, absolutely. So you're going to, it's the scale. So we wanted to provide something where you could see a scale, but it is really, we're doing that for, we work for Johns Hopkins doing lighting projects for them, and there's a couple, I'm not sure if I'm supposed to say, but there's a couple of those schools that we do it and actually just go out and replace LEDs. And it's really just a matter of scale in order to bundle into a financing project. So if you're doing, like, again, we're going to roll through our campus and we're going to fund it as we go. And that's the way we work for some, where it's like, hey, we're going to plan this project and, we're going to do 20 buildings at a time, and this is how we want to do it. That is doable. But if you're going to do a financing solution, then you need some scale. The other thing we do a lot particularly for private nonprofits, is off-balance sheet financing or contingent payment programs, which can be very, very attractive for balance sheet protection. So, and again, typically you want to get at least above $1 million in project size in order to make that a financeable project. So again, it's a matter of how we're doing, what matters to the institution, and then how we're structuring it to meet those needs. But yeah, that's just a rule of thumb. Think above $1 million, or really, yeah, above $1 million to make it a financeable project. And then we'll take
getting a few other questions. Oh, I'm sorry, Regina, go ahead.
No, I was just going to say, and then again, it's a turnkey solution for the college or university as well. So everything, and that is a cradle to grave. So even recycling all the bulbs and ballasts and all that. So and so that's also kind of nice as far as manpower goes.
Okay. Another question is, a lot of universities have to file the 990P IRS form, and the challenge is finding who that person is.
The person that files, or yeah, they have to file the 990.
I'm going to ask Michael to clarify that for you. I got another question regarding the recording of this. It will be posted to the APO webpage later this afternoon. You'll also receive a follow-up email tomorrow with a link directly to the recording as well. And as far as the presentation slides, after you receive your follow-up email tomorrow, just send me an email at Billie, B-I-L-L-I-E, @appa.org, and I will send you a copy of the presentation slides. So at this time, I believe that is all of the questions we have. We had someone who was very nice to put in a link to where to get some of the IRS government forms and the Treasury government forms. So
nice. Okay.
That has been put into the chat for everyone.
Perfect.
So at this time, I would like, I need to put my email address into the chat box for everyone. Okay, so at this time, I don't see any other questions coming in. So Regina and Abigail, just wanted to say thank you so much for this very informative webinar today, and we have lots of questions. We have some questions that will be answered directly by one of our presenters. I think they were in very much of a unique question to be answered, so they'll be getting back to you. So, ladies, thank you so much for your time. And as always, to our attendees, thank you for your time. And until next time, be safe, stay healthy, and let's be kind to one another. Thank you so much. Bye-bye now.
Thank you.